Hey YouTube, I'm Jimmy. In this video, I'm going to walk through my analysis of Pfizer, ticker symbol PFE. This is a 20-second video in our series where we're analyzing all 30 stocks in the Dow Jones Industrial Average. We're then going to take that analysis and build three different portfolios: a dividend, a value, and a growth portfolio. Pfizer is a global pharmaceutical company, a lot like Merck, which we analyzed a few videos ago. Now, in Pfizer's most recent annual report, they define their business as providing medicines and vaccines. Plus, they have some consumer healthcare products, but we'll come back to that in a second. Now, one of the keys to any pharmaceutical company is the drugs that they control. This is a list of all the drugs that Pfizer currently controls, and I threw in how much each drug added to revenue. And as you can see, their big drug right now is Lyrica, which added about 8.6% to revenue back in 2017. And interestingly, their patent just went away at the end of 2018. Now, Pfizer is somewhat unique in that they have no one drug that dominates their revenue. Some smaller pharmaceutical companies have a single drug that provides like 40 or 50 or 60% of revenue, and obviously that hurts them a lot more when they lose that patent. Now, this type of product diversification, stability of revenue, and ultimately the defensiveness of their type of business might explain why they were such a strong performer in 2018. They put up almost a 25% gain in 2018. Their stock, Pfizer stock, returned almost 25% in 2018. Okay, now that we know that they did good in 2018, let's have a look at their numbers and see if we could see how revenue is done. Revenue hasn't done all that much. Now, 2018's numbers aren't final yet. Only the first 3 quarters are in. So that's why you see 2018 as a projection, but it's really only a partial projection because, like I said, the first 3 quarters are in. So they're only projecting the 4th quarter. Now, when we switch to net income, we could see the first thing that jumps out to me is the expected jump in net income in 2018 and even more so in 2019. Now, in 2018, the first 3 quarters are already in, and I would expect them to hit that. In fact, analysts are estimating about 3.7 to 3.8 billion in profits in the 4th quarter, and if they do that, then they'll be in line with what our green bar is, our 2018 green bar is. Now, one of the reasons for optimism as far as Pfizer's stock is concerned, at least it has been in the past few months, is that their new CEO is shifting around some things for the business. They bring up 3 things. First, they plan on Pfizer focusing more on the specialty medicines and keep a lot of the research dollars that they put out in line with specialty medicines. Second, they've stated their desire to find more profitable and accretive acquisitions. Then third, they're trying to clean up the organizational structure. They want Pfizer to be far less bureaucratic than it has been in years past. And ultimately, I think that a lot of investors were very happy when they saw these changes. And that's one of the reasons that led to one of the reasons that Pfizer had such outperformance in 2018. Another possible reason for the outperformance in 2018 was the fact that Pfizer has a few drugs that are expected to provide some growth for their top line. Now, if we switch back to the revenue chart, we can see that their top line could really use some growth. Now, if we compare their top line to their net income line, we can see that net income's done a bit better. And one of the reasons for the improvement in net income and not revenue was that their net income, they got charged a lower tax rate, likely because of the tax changes. So charge less taxes, you end up with bigger profits. And this brings us to some recent news. So in the middle of last month, Pfizer announced a joint venture with GlaxoSmithKline. And basically what they're going to be doing is the 2 companies will be forming another company. Pfizer will give that new company their consumer healthcare business. That was the one that I mentioned before. And GlaxoSmithKline will be giving their consumer healthcare business. Once combined, the new company is expected to have about 12.7 billion in revenue. Now, Pfizer will own about 32% of the new company. And since they'll have less than 50%, they're no longer going to consolidate the revenue. Basically, that means that they're not going to put the revenue inside of Pfizer the way it is right now. So instead, what they're likely to have to use is something called the equity method of accounting. And generally, in the equity method of accounting, you would use that if a company owns between 20% and 50% of another company. So it basically, on their financials, it'll look like an investment that they made. Even though Pfizer doesn't have to put up any capital, they just have to give them a piece of the business. And it might make sense for me to do a video on that topic because that's an interesting topic and a lot of companies do it. If that's something you'd be interested in seeing, let me know in the comments below. So for Pfizer, they expect this joint venture to generate income for them each and every year. And the reason that they would do something like this, both Pfizer and GlaxoSmithKline, is that when they combine their businesses, well, in theory, there should be synergies between the 2 companies, and ultimately, they claim that they think they're going to save about $650 million between the 2 firms. So it could make them both a bit more efficient. Now, before we jump into valuing Pfizer stock, let's have a quick look at their dividends. This is a chart of their dividends going back to 2011, and I think that this is one of the more appealing parts to investing in this type of company. Well, the dividends and the defensive nature of the companies, but I thought it might be interesting in this video to try to use the dividends as a way to value Pfizer's stock. So there's a valuation technique called the dividend discount model. And basically, the dividend discount model assumes that a stock should be worth the same as the present value of all the future dividends. So there are a few ways to calculate the dividend discount model. Now, let's imagine that we only want to hold Pfizer stock for, let's say, 1 year. So in theory, we say that today the stock is trading at about $43 per share. Well, we buy it for $43. Then we believe that we're going to get $1.45 in dividends over the next 12 months. Well, at the end of the year, let's say we're going to sell that stock and we're going to get $45 a share, maybe $50 a share, whatever it might be. So what we do is we simply have to say, okay, in 1 year it's going to be worth whatever. We're going to bring that back. We're going to get $1.45 spread out amongst each quarter. We're going to bring that back to today. What is all of that worth today? And if it's trading for less than that, you go ahead and buy it. If it's trading for more, you walk away. Now we could perform the same analysis if we're doing it for 2 years or 3 years or 5 years or whatever our number was. But now if we're not sure how long we want to hold the stock, there's another way to do it, and that's called the Gordon Growth Model. The Gordon Growth Model is a version of the dividend discount model. And that's what we're going to use for Pfizer stock. So basically, we take the Gordon Growth Model. Here's what the formula looks like. And what we have to do is we have to determine what we expect in dividends going out the next year. In our case, it's $1.45. I just took that from analyst estimates. Now we need a few more pieces of information. So we need a growth rate of the dividends. Now, I'm assuming a growth rate of about 6% for dividends going forward. And I got that number by looking at recent growth of their dividends and projected growth of their dividends. And it seems that 6% is a fair number to use. And then we need a required rate of return. Now, we used a weighted average cost of capital of 8.5% when we did Merck. We used discounted cash flow over there. And our WACC in that case was 8.5%. And for me, that seems like a fair number to use for our dividend discount model as well. So all we have to do is take next year's dividend and divide that by R minus G, where R is the required rate of return and G is the expected growth rate of the dividend. That gives us a fair value of about $58 per share. So with a current price of about $43 per share, the $58 price target looks pretty good. Now, I think it's important to remember that one of the holes of the dividend discount model, especially the Gordon Growth Model, is that we are assuming that the dividend growth rate will stay at 6% forever. And that may not be the case. I expect it to vary, but the math here assumes it'll be consistently 6% no matter what. Now, if we drop our growth rate to 5%, our fair value drops to $41. If we up it to 7%, it jumps to $97. So I think it's important to remember that these types of calculations where we assume a perpetual growth rate, well, they're very sensitive to their inputs. And for me, the same is true with the required rate of return. But we used 8.5%, but I think if we were to change that in a material way, that would likely have a big impact on the fair value of the stock. That being said, I actually think that we used somewhat conservative numbers with Pfizer, so I'm okay with the inputs that we used. Now, I think it's important to consider how a Pfizer or really any pharmaceutical company would fit into our portfolio. So we use the dividend discount model, so clearly we're favoring dividends in this case. But pharmaceutical companies tend to be quite defensive, so it might be helpful to realize that they might have a role in a different portfolio, maybe the value portfolio, if we believe that they're really worth $58 compared to today's price of about $43. And as far as the growth portfolio is concerned, I'm not sure it makes a lot of sense in the growth portfolio because we saw what revenue is doing. Net income isn't doing all that great. But what do you think? Which portfolio do you think Pfizer stock belongs in? If any at all, let me know what you think in the comments below. And if you haven't done so already, hit the subscribe button. Thank you for sticking with me all the way to the end of the video, and I'll see you in the next video. Thanks.